Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Are you ready for some straight talk on retirement planning without all the fluff? Well, you found the right podcast. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. I'm Greg Gonzalez. This is going to be episode number 182. We're going to be talking about changing your mindset, another way to think about retirement, because I just find this fascinating. When I'm having a conversation with somebody that's maybe between a couple months away from retirement to a couple years out from retirement, maybe it's as many as 5 years away from retirement, and the things that are top of mind to them, their concerns about retirement and where they're at are sometimes, and just their viewpoint of, hey, how's this going to all pan out? These mindsets that people have are just so interesting to me. And the way they think about retirement is totally different than like a financial planner like myself thinks about retirement and making sure the pieces are all lined up correctly and accounted for. So I think, or I hope, this will be a very beneficial segment of the episode today is changing your mindset when it comes to retirement. And what I mean by that is just imagine you're looking off in the horizon. If we change the lens in your glasses, your vision is different. And sometimes I think just having a third party look at your situation and giving you a second opinion can be extremely valuable because they might see something that you had completely overlooked. But more often than not, I'm finding myself saying, now that I understand your situation, if I was in your shoes, I would be most concerned about X, Y, and Z. And let's talk about a strategy or something we can do to mitigate those risks, because those risks may not even have been on your radar, or if you did realize they were there, maybe you underestimated the overall impact of them. So the first segment of the show, we will talk about changing your vision. And I want to put some perspective around this. I will be happy to share my experience of talking to pre-retirees and the way they're looking ahead most often, the frequent concerns that we talk about and discuss together, and really how you can refocus your mindset on retirement just by switching the lens. And then, of course, later on in the show, which we try to do every so often, is answering some of your listener questions. A lot of people go to our website, retirementmadeeasypodcast.com, and many listeners submit their questions, which we're going to go over probably about 3 to 6 at the end of this episode. I've gotten some requests to end every episode with listener questions. So instead of doing one whole episode on listener questions, we're going to try to cover 3 to 6 every single episode, and it'll be the second half of every episode for you to enjoy. So if you haven't already, go to our website, retirementmadeeasypodcast.com, submit your questions. It's free. I'd be happy to address your question. Of course, I'll keep it anonymous, and we'll have a little fun. While you're on the website, there's a resource section. Again, don't charge for any of the resources. We've got a Social Security guide. We've got a retirement guide. We got a tax guide. You can download all of those. And then lastly, for those people that are wanting help, wanting a professional retirement planner to help them build a retirement plan and get that conversation started, there's a form you can fill out on the website that's called Work With Us. And that's how we get the conversation started to see if we're going to be a good fit for you as you plan for your own successful retirement. This year, we rebranded our firm to Retire Strong Financial Advisors. So we are revamping the website, rebuilding it. There will be more sources available, like our Women's Guide Retirement. That will be out shortly. I'm actually going to do an episode coming up here in the first quarter anyway. I'm going to try to, on the challenges that women have versus men when it comes to retirement planning. Nobody wants to talk about this, but hey, I'm going to talk about it. It should be very interesting to you. It was just 1974 when women were allowed to have credit, for goodness sakes. So please look forward to that episode coming up. Okay, let's jump into this week's episode. I'm calling this Changing Your Mindset When It Comes to Retirement. And really how I came up with this discussion was just after years and years and years of meeting with people who are trying to plan for a successful retirement. Some of them even attended seminars. I used to do a lot more seminars back in the day at libraries and community colleges. That was before my podcast days, but I would always ask people, as you look ahead at the years in front of you, those are your golden years, your retirement years. What 3 things are most concerning to you? And I've asked that same question hundreds of times to different people. And there's a reason that I ask this question, because from my standpoint, a lot of times what concerns us, what worries us most, is what's keeping us from getting everything that we want. And I can go over, because I've kept a lot of these evaluations, I've kept notes over the years, and I have seen a lot of commonality in the answers that people give. When you look ahead at retirement, what are the 3 things that you're most concerned about? There's a lot of people that will say running out of money. A lot of people will say taxes. A lot of people worry that their kids are going to be okay. And it doesn't matter how old their kids are, they still worry about them. A lot of other people think about healthcare costs and how out of control healthcare costs have gotten and how high they're probably going to be in the future. And more recently, people are more and more concerned about inflation and the cost of living going up. Other people, they'll write something like outliving my money or living too long. Along with that same thought is being able to afford long-term care or assisted living or nursing care in the future. And really the list goes on of different concerns or fears that people have about retirement. And I would invite you, if you haven't thought about this, as you think ahead, close your eyes. What are you most concerned about? What are you afraid of when it comes to retirement? Because really your experiences shape your mindset. For example, if I'm talking to somebody that has a mother that they love deeply and they're helping care for, and maybe their mother needs more care than they can provide at this point, and they're forced to make a decision about assisted living, and they're looking at the costs, they might start to think, gosh, if this is what it costs today in 30 years when I might need this care, how much is it going to cost? And am I going to be able to pay for that? And sometimes it's even, maybe they heard something that was memorable from someone that either that they work with, a family member, a friend, someone that they hold in high regard or they have a lot of respect for. And they might say, well, Uncle Bobby said, take that Social Security as soon as you can get it because you're not promised tomorrow. And that kind of shapes, again, their mindset. Or Dad always said, never buy an individual stock because he owned Eastman Kodak and it went belly up. So these experiences in life, conversations we've had, things we remember really, really shape our mindset. And I think that's one of the challenges when it comes to retirement is you don't know what you don't know. And there could be things that you're missing, literally lifelong, life-changing impacts, because retirement is such a big decision. And if you get it right, you do it once, but maybe there's a lot of things out there that nobody's warning us about, no one's coaching us on, and they definitely might not be our top 3 or 5 concerns that are top of mind to us, because that's where we choose to focus our mindset on. And I've had these conversations with people that they say, gosh, if I can just do my Roth conversions right, everything's going to fall into place. Or if I just pick the right long-term care policy, I'll be just fine. Everything else is going to be just fine because that's my big risk. Or if I buy this investment product that has the words guaranteed income on it, I'll be just fine. This is the magic bullet. I've heard that before, believe me. So you might be asking yourself, what's a better mindset for retirement? How can we adjust our way of thinking? I think first off, you got to figure out what's going to make you happy. And I've said this a lot of times on the podcast, jumping into retirement, like jumping into the deep end, is not a good idea for everybody. Some people find the semi-retired life extremely enjoyable and just a fantastic adjustment into retirement. That might not be possible for you. You might have to find a new opportunity that allows you to do that. But I think that's a conversation that needs to be had is what's going to make you happy here? The other thing is what's holding you back from retirement? Is it just a lack of confidence in your current financial state, which is what I hear from a lot of people? In other words, they say, okay, how much could I afford to live on in retirement? And is that replacing what I currently make? And I've heard people say, well, gosh, if I could just live on my earnings and my 401k, I'll be just fine. And the next question is, okay, what if you don't have earnings? What if, hypothetically, you didn't have earnings in your 401k for a number of years? How would that impact your plan? And then you might say, well, that's what I'm concerned about. I want enough so I never have to go back to work, tail between my legs saying, hey, will you hire me back? I've heard a lot of people say, hey, retirement, we want this to be a permanent decision. We don't want this to be a temporary decision here. We don't want this to be a temporary lifestyle change. And I get that. And the next thing you should think about is, what are you missing? And that could be health insurance, how health insurance is going to be different in retirement, and how are you going to afford that? If you have debt, how are you going to eliminate that debt in retirement? How are you going to account for big purchases in retirement, like a new vehicle purchase, trips, vacations, spending in retirement? What your strategy is to address long-term care planning, as we talked about. Another thing we didn't mention was, hey, if you have kids or you have heirs that are important to you, what do you want to leave them in the ideal world? Are you going to stay in your home? Are you going to move closer to family? Are you going to downsize? Again, it's a conversation that needs to be had. For example, I had a client that wanted to move closer to their adult son and grandchildren, daughter-in-law. And I said, what are the chances that they're going to stay where they are? Or is there a chance that your son might get a new job and have to move across the country? And that leaves you packing your bags, selling your home, and following them. And I remember they looked at me and said, how did you know that? How did you think of that? We need to talk to him. That's really important. And my answer to that is, I've seen this before. I've helped people. You're not the first people I've helped retire. This is not my first rodeo, as the expression goes. I'm even working with another couple right now that they have said, hey, St. Louis is not our forever home. When we retire, we want our retirement plan to reflect that, hey, we're moving back to where we call home, where we grew up, where we met, where we raised our kids, because that's where two of our children are and our grandkids. And upon retirement, we want to make sure we can sell our house and move back home. And then the last thing that's going to really play into shaping this new retirement mindset is the risks that really impact the overall success of your plan. And let me give you a couple examples of risks to somebody's plan. For example, I have a lot of people that say, I'm going to have $2,000 a month of part-time income in retirement, and that will help supplement my other income sources. And I want to work for X amount of years being semi-retired and making $2,000 a month. That's fantastic. That's a great goal. It's very specific. We got a number of years, amount of money, and it can be even on the conservative side. But heaven forbid, what if you were unable to work? What if you had an accident, something happened? I don't know. So think about how that would impact your plan. If we're expecting $2,000 a month of income for the next 6 years, what if you were unable to work and that income wasn't present? What would that do to your overall plan? And that could be a big risk. Of course, we talked about the risk of needing long-term care. Let's say we had a husband and a wife and the husband was older and needed that care and it was $9,000 a month. What does that do to their overall retirement picture? And those are just two really quick examples off the top of my head. There's many, many more risks out there that might be more applicable to your retirement plan. Here's one quick one, which is going to lead into the first question that we get into. What about your pension risk? If you're receiving a monthly pension from the company that you retired from, imagine 5 years into retirement, all of a sudden you get a letter in the mail saying this pension fund has been mismanaged. There's not enough money to go around. The pension fund is going into bankruptcy and we're no longer able to pay you the $2,000 a month you were receiving, but we can afford to pay you now $800 a month. What does that do to your overall retirement plan? And was that a risk that you had thought of ahead of time? So let's jump into that question. A listener went to our website, retirementmadeeasypodcast.com, submitted this question. She was concerned about, this is from Julie. We're going to stay anonymous here. She was concerned about her husband's pension. She was 100% joint and survivor, which means if her husband predeceased her, she would continue to get the same exact amount. But her question was, well, what if down the road, okay, the pension's in good shape now, but we're 62 here. She's 62, he's 65. What happens if 10 years down the road, the pension runs into trouble, is that money guaranteed? Is that pension check guaranteed for the rest of his life? Julie says that her husband's getting approximately $2,200 a month. What are the chances that's really going to be around? This is something that keeps her up at night. And my response is based on the fact that her husband's pension is a private sector pension, and therefore it's probably insured by the PBGC, Pension Benefit Guarantee Corporation. We will have a link in the show notes so you can get some more information on it. If your company's pension plan is in trouble, you will definitely want to contact them and understand, hey, how much of your pension is really insured here. And again, the PBGC does not cover public pensions, military pensions, government pensions, local, state, and federal pensions, 401ks, IRAs, profit sharing plans, none of that. We're talking about defined benefit pension plans. Again, this is private sector. Now, these pensions pay for this insurance coverage in case they default. And then basically what happens is all the pension assets then get turned over to the PBGC. They then handle everything at that point. This does not cover, there's not a guaranteed protection for your entire pension benefit. There is certainly a limit on how much they will cover. And there's a lot of factors that determine how much of your pension would be insured. Those being whether your pension plan was a single employer plan or a multi-employer plan. What age were you when you collected your pension? How many years of service did you have? And if it just happens to be a multi-employer pension plan, you're looking at a little over $1,000 a month that they would insure. So if you were receiving a pension of $2,000 a month, well, they would pay about half. And that is not indexed for inflation either. If you do have a private pension, it is worth looking into these things to seeing how well funded this pension is. That might look good today, but in 20 years, will it be as well run? And it's a fair question. If it were to go belly up, if the pension does go bankrupt, how much of your pension is insured by the PBGC? You can contact them and get more information. Julie, I hope that helps. The next question is pretty short, and I like it though. It's from Sarah, listener Sarah. She said, I don't understand how financial planners get paid. Can you explain this in plain English? Thank you, Sarah. Sarah, I'll do my best to make this very simple. There are 3 ways if you've got a pen, 1, 2, and 3. One way that advisors, financial planners can get paid is they can charge hourly or flat fee billing. Some firms might charge you X amount of dollars an hour. It's very similar to an attorney. For my new office space, I had an attorney review my commercial lease, and he charged me $250 an hour. He told me it would take 6 hours to review, 3 to 6 hours to review, and he charged me 10 hours. I wasn't happy, but what are you going to do? So that is the first way advisors can charge hourly or flat fee billing for their time and their work. The second way is advisors can make commissions. And commissions, when you say the word commission, it does have a bad ring to it. But you might have an advisor who is compensated through an investment or insurance product. For example, you buy a life insurance policy from them and they make a commission. You buy a stock or investment, they might have a commission. So the way they make money is when you buy or sell some kind of investment or insurance product. And the last way is those advisors that charge an advisory fee, sometimes called a assets under management fee, a portfolio management fee. And this comes out of your investment account on a periodic basis. Typically, it's broken up into quarterly or monthly installments. Now, this should be disclosed to you. All 3 should absolutely be disclosed to you, and you should be comfortable with this arrangement. And that's one of my hot buttons, if you will, is I ask a lot of people, maybe they're working with a financial advisor before they meet me, and maybe they're unhappy with his or her services. I ask them, hey, are you aware of, or what are you currently paying your current provider? and they have no idea. And that just bugs me because I think it's very important that these costs are disclosed to people, that they are aware and very familiar with what they're paying. Because if you don't know what you're paying, how do you know if it's of value to you? So Sarah, I hope that helps you. There's 3 different ways again. And if you happen to talk to a financial planner that says, hey, you can pay me with Amazon gift cards or Bitcoin or something like that, find somebody else because they're not legit. The next question comes from Peter. He said that he's been listening to the podcast for 2 years now. And Peter wants to know, how do you manage taxes and pay them in retirement? Surely all of your clients cannot be paying quarterly estimated taxes. Thanks, Peter. Peter, this is a fantastic question. No, all of our clients are not paying quarterly estimated taxes. Some do, because that might be their preference. It might be their tax advisor's preference, and that's totally okay. Some of our clients withhold the taxes from their Social Security check, from their traditional IRA or 401k distributions. They might have taxes withheld from their pension checks. We even have the ability to send in a distribution directly to Uncle Sam if we know, hey, there's a tax liability here. So that's how they're doing it. A lot of people, personally, I will not do quarterly estimated taxes when I'm retired. That's just too much. And I personally like things simple. So for my own self, I will choose to have taxes just withheld out of either Social Security or IRA distributions when I get to that point. And when you're doing estimates a year in advance, it's really useful because you can say, okay, this is our estimated tax liability for the year. How much are we withholding on our Social Security check, on our pension check, on our IRA or 401k distributions? And does that equal enough where we have withheld an ample amount of taxes so we don't owe anything? Now, in retirement, I will agree with Peter. It's a little bit more challenging. It's different than what we're used to. If you're used to getting a paycheck and you're having those taxes withheld, it's done automatically for you. In retirement, you got to have a game plan. And one thing I will say is, I would say that 9 out of 10 people don't withhold taxes on their Social Security checks. And that's okay. That's their choice. It's not mandatory to withhold federal income taxes on your Social Security check, but you really, really need to say, okay, how much of my Social Security is going to be taxed? What is the tax implication? And are you withholding that amount from somewhere else to make up for it? Now, I've mentioned this before, and I'm not going to get political on this podcast. There are a ton of other podcasts. There are a ton of other news channels that will get political, and you can enjoy those. But what I will state is that President Trump, during his campaign, mentioned that he intended to stop taxes on Social Security checks. Now, that might not happen. But if it did, and I have many clients that hope it does, and again, we're not getting political here, but I'm able to run with my software and my planning somebody's lifetime tax liability. And when you take out the taxes that they pay on Social Security, it can have a drastic difference. And they are already banking on this, hoping that it happens so that they can increase their Roth conversions in the future. We'll just have to wait and see if it happens. And the last question of this week's episode is coming from Angela. Angela writes a short question, which I like too. Greg, can you explain the difference between the after-tax 401k and the Roth 401k? I was on my company's 401k website and didn't understand the difference. I thought I remember you talking about the Roth 401k, but the after-tax sounds the same. Isn't the Roth 401k after-tax? Aren't they the same? Thanks for your help, Angela. This is a fantastic question. This is one of the best questions I've received in months, so thanks, Angela. And everybody needs to hear this. If you have a 401k and you're contributing to the Roth 401k, you need to make sure you're not contributing to the after-tax 401k. Because how the after-tax 401k works, let's say you contribute $10,000 to the after-tax 401k, and years go by and it grows, and it's now worth $18,000. So you've got $8,000 of growth. The 10 that you put in was after-tax money, and it grew by $8,000. So now it's worth $18,000. You go to withdraw the money, you're going to pay ordinary income taxes on the $8,000 of growth. And then the $10,000 that you put in, that's considered return of principal. Versus the same scenario, you put $10,000 in the Roth 401k. Years go by, it grows to $18,000. So it grew by $8,000. And you go to take a withdrawal out of your Roth 401k, it's all completely tax-free. I met with somebody who was a referral to me. It's been a couple of years ago, and I'm now working with this person, and she wouldn't mind me sharing her story. But I told her, after reviewing some of her statements, I said, you're making a huge mistake, and you have no idea, and it's costing you tens of thousands of dollars in taxes, but we can fix it. And I explained to her what she was doing, and she said, gosh, I thought after tax was the same thing as Roth. I didn't even see that Roth was below the after tax, and I just thought they were the same. So whenever you see Roth 401k or Roth IRA, again, it's going to be tax-free growth. And I think we can all agree there's nothing better than tax-free money, tax-free growth. Now, with that being said, if you do have money in the after-tax bucket and you don't know it, you'll want to check with your plan, 401k plan custodian to see about possibly doing a Roth conversion, converting the money in the after-tax 401k bucket to the Roth 401k bucket. You'll want to ask them about the tax implications. You'll want to run that by your financial planner, your tax advisor, to make sure it's going to make sense for you. But I cannot tell you how many times I have pointed this out to people and they just didn't know the difference. They didn't know there was a difference between the after-tax 401k and the Roth 401k. Now, there's a footnote to this. There are some people that are not eligible to contribute to the Roth 401k based on their earnings. They might be considered a highly compensated employee, and therefore they have to contribute to the after-tax 401k, and they should consider doing a Roth conversion and making sure that after-tax 401k is in their best interest. Again, talk to your financial planner, your tax advisor, and your 401k custodian. And that's all I got this week. So please go to our website, retirementmadeeasypodcast.com, submit your questions, download our resources, book a time to chat with us if you're looking for a financial planner. We'll see you next time. And remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, many others may carry additional fees, charges, and restrictions, and the policyholder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.